Can't you sing or something, Kevin?
Well, good morning. Yes, thank you, Mark. It's 11 o'clock, so I think it's time for us to make a start. If I could ask the panelists to take themselves off mute, we'll get going. So, good morning and welcome to all our attendees and indeed to our panel, to our online webinar this morning that will consider some of the challenges that the recent market conditions are having on financing real estate projects. My name is Kevin Marriott from IPSX, and it is my pleasure to be your host this morning. I think it's fair to say that just about almost every business across every sector in the UK has been adversely affected in some way by coronavirus. And in this morning's session, we're going to be discussing options that owners of real estate now have when thinking about capital raising, and ideas that they could be considering too when thinking about raising new finance, whether that be for development projects that they're working on or indeed for their own businesses. There's also going to be some audience participation this morning, and we've got some live polling for you, and I'll come back to that a little bit later on as to how that's going to work. But first of all, let me start by thanking our hosts, our virtual hosts, I should add, DLA Piper today. Thank you to the team for helping us put together today's webinar. I'm sure we're in for a great session. So let's kick off by welcoming our panel and what they're going to do in terms of guiding us through the topic today. So without further ado, it's my great pleasure to introduce Susan Samuel, partner at DLA Piper. Good morning to you, Susan.
Good morning, Kevin.
And good morning to Simon Cullimore, Director at Valuation Advisory at Jones Lang LaSalle. Good morning to you, Simon.
Morning.
And to Marc Roberts, who's a partner in the real estate team at Grant Thornton. Good morning to you, Marc.
Okay.
And finally to Roger Clarke, Managing Director and Head of Capital Markets at IPSX. Good morning, Roger.
Hi, Kevin, and good morning, everyone.
Fantastic. So good morning, panel. Great to have you all with us, and looking forward to your contributions shortly. So before we make a start, just some housekeeping points, if I may, for our attendees this morning. Please do ask any of the panel questions or points or observations as we're going along. You can find the Q&A box at the bottom of your Zoom bar. I should just mention that all participants are muted. So this is the easiest way for us to be able to interact with your thoughts and points. So please do ask any questions or points to the team as we're going along. That would be great. Now, I mentioned in my introduction that we're going to have some audience interaction, and to warm things up, we're going to start with a couple of, I hope, fairly easy questions for our attendees to answer. So without further ado, let's have our first question, please. So we've lost the questions. That's rather frustrating, isn't it? I was hoping that, there we go.
Here it is now.
Fantastic. It's up here. There we go. Thank you very much. So first question for our attendees. Are you considering releasing equity from real estate that you own? Now, there are going to be attendees with us that are not in that position. And I might just add into that, if I may, a little caveat, which would be if you are working with asset owners who are thinking about this as an option, please you vote along as well. So if we could ask our attendees to give us their thoughts on that one, please. And let's go to see what that poll gave us, if we can get the results to that. Interesting. So at the moment, we've got a majority saying no, they're not. So it will be very interesting to see if that shifts and moves around over the next hour as we go through the conversation. Okay, thank you. Let's take the poll results down, and let's have our second question, our warm-up question, please, for the attendees. So do you think in the next 3 months that we'll be needing to look at raising finance for real estate projects? And I can, again, just caveat that, if I may, if you are working with real estate owners, whether that be private or indeed public sector, who you think will be looking to be raising finance on projects that they are working on, development projects, or on areas that they are concerned with, then please do vote along. So if I could ask our audience to make their votes on that, that would be great. Thank you very much. And let's get the results to that. Very good. A much stronger positive response. Look at that, 78%. Wow. Are saying yes, they are going to be looking at this. So highly appropriate, highly relevant, and I am sure our panel will be reflecting on those poll results as we start to get into our conversation. So let's do that. If we can just take the poll results away, that'd be great. Thank you very much. So let's make a start on our session this morning, and I'm going to invite Roger Clarke to give us a bit of an update on the progress that IPSX has been making. The news of the second market of IPSX Wholesale that was announced at the beginning of the year, and how that, as a new market, could help make a difference with fundraising. And I am sure there's many participants here today that don't know very much about wholesale, Roger, so I'm sure that you're going to be explaining that to us. But Roger, since we were in Leeds, last time, that was nearly 6 months ago, there's been quite a lot of progress and a lot happening at IPSX. Could you tell us a little bit more about that?
Yeah, thanks, Kevin. Indeed, there has. The last 6 months have been very busy. They started off back in December with a decisive outcome in the general election. And I think everybody would agree that we all in the industry went into 2020 with a spring in our step, and looking forward to far more active capital markets and a lot more stability. Certainly we at IPSX were, because the first two transactions that were going to come onto our IPSX Prime market went into full execution mode. Prospectuses were drafted by teams of lawyers and accountants, and in the investment banks who were handling the issues started pre-marketing them. And then, of course, at the beginning of March, lockdown came along, and things were put slightly on hold, at least temporarily. Temporarily things were put on hold because 3 months ago, none of us had probably ever used Zoom. Now, of course, we all live on Zoom and realize that you can actually carry on having a functioning capital market. We also in March had stock markets that even those of us who've been working for decades in markets, we'd never seen anything like it before. And we've never seen anything like it before on the way down. And it's been a pretty rapid bounce back as well since then. We hit the lows on the 23rd of March. Since when, not quite true today as I sit here saying this, but at one point this week on Monday, the S&P 500 actually set a new high for the year, which is extraordinary when you think about it. Capital markets are working, and we are now fully engaged again with IPSX Prime with those first two issues. IPSX Prime, as a quick reminder, is a regulated stock market dedicated to real estate assets. It's a recognized investment exchange, which means it's fully regulated by the FCA. It's a recognized stock exchange as far as HMRC are concerned. And that's important because it means companies that list on our exchange can be REITs as long as they satisfy other eligibility requirements. And importantly, these shares are shares just like anyone is used to buying in Vodafone or Lloyds Bank. They can go into a SIP, they can go into an ISA, they settle in Crest, just like any other share. So a company that wants to list on our Prime market needs to sell at least 25% of the shares. And that's important because it means that the vendor, the issuer, the person who owns the real estate asset to start with, doesn't need to sell the whole economic exposure. They technically put the whole asset into a company, but they can retain shares in the company up to 75%. Of course, that provides a great deal of flexibility when people are thinking about how to raise finance from their real estate assets. It's not a binary sell or keep. This market is designed for core plus assets, stabilized, income producing, low risk, low leverage. LTV is limited to a maximum of 40%. These shares are going to be bought by people who want asset-backed income sources, people seeking wealth protection, which, by the way, is a huge, huge part of the capital markets today. You don't get as much income from owning shares in Shell anymore. You don't get as much income from owning gilts issued by the government anymore, but you can still get quite good sources of income from real estate, although, of course, that's become a little bit more challenged recently than it used to be. I mentioned the FCA. These shares get sold by a company issuing a prospectus, which is pre-vetted in advance by the FCA. This means that all levels of due diligence, of legal certainty, financial certainty, risk factor disclosures, strategy disclosures, valuation of the assets, they're all to what we call a prospectus standard. No standard is higher. And finally, and importantly, once the IPO has happened and you own these shares, liquidity in the market is provided by a system of market makers. This will be a handful of investment banks who are going to make firm two-way quotes, prices for shares every day, all day long during the trading day. And that, of course, contrasts quite importantly with the way some retail investors have been able to access the property market, the asset class in the past, through open-ended funds, many of which remain gated today. Gating will simply, by definition, never happen on IPSX. That's the prime market. And that is a market that we talked about a little bit when we last visited Leeds in November. Since then, in December 2019, the FCA finally gave us approval for our second market. This is called IPSX Wholesale. And this has a few differences. It is only for institutional and professional investors. And because of that, some of the protections that the FCA likes to see for the man in the street don't need to be there. And because their protections aren't there, it means there's a lot more opportunity for owners of assets and investors in assets. What do I mean by that? Well, it means that the assets don't necessarily need to be stabilized, income-producing assets. There might be a chance to invest in development projects. There might be a chance to invest into JV REITs, which are coming back on shore. Offshore structures are no longer really supported by governments, and that was the case anyway, even before we went into the COVID-19 lockdown. Offshore is now not a good thing. But to come onshore, these companies will have to allow some free float. Importantly, there's no prescribed minimum free float. So we might see companies issuing very small numbers of shares, in some cases as little as 1% for the very biggest assets. But that provides a really interesting opportunity for people to invest in some of the most iconic, most well-known assets in the country. LTV can be higher, up to 80%. And from the point of view of the issuer, the process is streamlined. It's a little bit quicker. It's a little bit cheaper, largely because a prospectus doesn't need to be pre-approved in advance by the FCA. What's known as an admission document simply needs to be filed with us as the exchange. It includes a lot of the same information, but not having to put it through the FCA makes it quicker and cheaper. Kevin, if we could move on to the next slide. I think that it's very important for owners of real estate, when they're thinking about using IPSX, to understand where the new demand for shares in real estate is coming from. It's the first question I'm usually asked is, okay, this is a great idea, but who is going to buy these shares? Well, investors, we are going to attract new investors and new sources of capital into the real estate capital markets, largely because they are excluded usually, because real estate's big, it's expensive, it's difficult to buy, it's difficult to manage, and it needs to be managed well. And this means that all but the very largest institutions are usually excluded from real estate capital markets. And they're usually excluded even from the listed real estate markets, the REIT markets, because the way the equity capital markets are set up is not really very retail investor friendly. It doesn't really appeal to family office and private bank investors because they don't like volatility. And it doesn't really appeal to the smaller institutions who are incredibly focused on liquidity when they're investing into shares, and some of the smaller shares, for various reasons to do with MiFID II, etc., tend to display lower levels of liquidity. All of that's going to change on IPSX, and I can explain why in due course if anyone is interested. But if you take what I say as a given, that it will attract far more investor capital, attracted by the access to new product that the issuers will bring to the market. It'll be attracted by transparent market pricing. You know, today it's very hard. Well, today it's not possible to get a daily price for a piece of real estate. You can get a daily price for something like a large REIT like British Land. But British Land is a portfolio with hundreds of properties in it. The price of the shares of British Land doesn't really tell you anything about what's happened to the value of Broadgate versus the value of Meadowhall versus the value of Paddington Basin. And if I'm an investor these days, I want to know what I'm buying, I want to choose what I'm buying, and I want to know what it's worth. And if we can give that to people, it attracts huge swathes of new capital into our real estate markets. And of course, investors have to be protected. The regulation that comes with our listed market is, again, in a big contrast to actually buying a single direct piece of real estate. That's really only for grown-ups and professionals. But because of the regulatory cover on our market, widows and orphans and everybody can get involved. Now, very briefly, Kevin, if we move on to the next slide, I just, before to finish up, want to show our viewers what the IPSX platform will actually look like. You'll be able to come onto our website and see here on a landing page all of the individual pieces of real estate which are listed. You can then take Cobra Place, for example. You can drill down then into that individual stock, and on the next page you'll see that this is then all of the detail that's available. As you see, you'll have information on the asset. You'll also have links to all of the property valuation reports, the filing documents, the prospectus, and on the next page we can then go further into actually some of the trading data and metrics on a daily basis that will be available at the single asset level. All brand new stuff. It's very exciting. It's unique. IPSX is the only exchange in the world doing this.
Great. Thank you very much indeed, Roger, for taking us through where IPSX is at, and indeed explaining a little bit more to us about those two markets of prime and wholesale and how different wholesale is. And I'm sure there's going to be quite a lot of questions and thoughts and observations coming back from the audience as they start to think about this as a new funding option. So let's now go to our panel for some of their thoughts and to look at the question that we're trying to answer today. So Simon, there's been a lot of conversation over the last few weeks around valuation, and Roger again pointed in his piece there about the importance of transparency to asset valuation. I am sure that you and other colleagues in the valuation profession have had a heck of a few weeks. What can you tell us about where you are seeing asset values just now?
Yeah, morning. Thanks, Kevin, and thanks for giving us the opportunity to be involved in this. It'll come as no surprise to anyone on this call that values have generally declined in the last few months. We've seen lockdown, social distancing, reduced rental income, and a general fall in confidence. And it's all connected with the speed of the economic decline, which has been absolutely unprecedented. The 5.8% fall in the UK GDP in March was the largest on record. Looking specifically at property values, and forgive me if I dive straight in with some statistics, but I am a valuer after all, and they do provide quite a good starting point for discussion. MCSI's Q1 release shows that capital returns for all property fell 2.6% in the first quarter of this year. The picture, as you would expect, has been varied between sectors, with retail offering the worst performance at minus 5.9%, and with shopping centres being the worst subsector at minus 10.5%. Leisure also has had a difficult time of it, being down 5.3%, but in contrast, offices and industrial have been relatively stable at minus 0.9% and minus 0.5% respectively. I would just like to put some of those figures into a little bit of longer term context. Many commentators have been saying that we have been in the late phase of the current property cycle for some time, and in some sectors we've seen some fairly major structural changes going on for certainly months and in some cases years. In retail in particular, values have been declining for some time, with retail showing an overall fall in value in the last 12 months at 14.6%, according to MSCI, with shopping centres falling nearly 25%. Therefore, whilst COVID has been a shock to the system and has obviously been pretty bad news, the changes that we're seeing in valuation now cannot all be laid at the door of COVID. JLL and indeed all valuers around the UK have been working very hard to collate evidence in the last 3 months, and we've also been working with our debt advisory teams and our capital market teams to understand sentiment and therefore pricing. There have been some deals happening, and I would like to stress that we have continued to carry out valuations despite the headwinds. Valuers have been using the much publicised RICS material uncertainty clause, which in my mind states the obvious situation that we're in at the moment, with unusual market conditions, unusual uncertainty, and therefore making a recommendation that valuations should be closely monitored and reviewed. Obviously, it's not an ideal situation, and it has put investors and banks off instructing valuations and indeed doing deals. But I think there is some good news here in that the material uncertainty clause has already been lifted for some sectors, things like long annuity type deals, healthcare, residential, supermarkets and agricultural stock. And I understand from a call this morning that it is about to be lifted on a further mainstream sector, which is all good news for us. Looking slightly ahead, I don't know anyone who is confident about the June quarter day. It's highly likely that rental receipts on investments will be reduced even further, and this is going to directly impact on income and therefore values, as well as further denting sentiment and confidence. And I don't think it's rocket science for us all to work out which sectors will be hardest hit. It's going to be those that rely on consumer face-to-face interactions. Not a very happy story so far, but I would just like to sort of finish my little section with some cautious optimism. Whilst we're not out of the woods yet, and I think the biggest problem we have is uncertainty regarding timing as to when things are going to fully open up again. But we've got to remember that fundamentally, UK property is a strong market. Borrowing rates are low and are expected to be for some time in the future. The spread of property yields and bond yields is attractive to institutional investors. UK yields look attractive when we compare them with European and even worldwide markets. In many sectors and subsectors of the market, vacancy rates are low, certainly lower than they were in the financial crash 12 years ago. And capital flows into property continue to be strong, with institutions generally having high allocations and incredibly strong demand from private equity. We are seeing investors returning to the market with a focus on those assets which offer stable income, assets which are viewed as being operationally critical, and assets which have lower occupational densities. So therefore we are seeing a lead in the charge for things like food retail, healthcare investments, and investments in the logistics sector, all performing pretty well at the moment. questions, I think, at the end, Kevin?
Yeah, no, thank you very much indeed, Simon. It was a tale of two halves, where you set the scene very, very well for us and took us through some very difficult and exceptional circumstances that you and your colleagues are working through, and I think that was absolutely fascinating. I am sure we're going to hear a little bit from Roger about where he sees sentiment, particularly investment sentiment at the moment for some of those real estate subsectors, and I'm sure we'll get back to that. But before we do that, let me go to Susan and ask Susan, perhaps you could bring us a bit of a regional reflection, if I may, about the kind of work that DLA are doing at the moment in Leeds in the North, and where you're finding your clients, and particularly your corporates that you're working with, and what you can share with us about where they're beginning to see things and what the kind of options are that they're asking you about.
Well, thank you, Kevin. Just by way of background to those that were viewing, and good morning, everyone. My area of expertise mainly is in the hospitality and leisure and consumer sectors, but I do act for real estate investors and developers across the board. It's fair to say that coronavirus, Kevin, has impacted all aspects of the real estate investment chain, from what we're seeing following the lockdown measures that were introduced on the 23rd of March, with all but non-essential shops closed and office-based businesses moving online. It's been a very difficult time for most of our clients. Basically, this reopening on the 15th of June for non-essential retail stores is a glimmer of hope for many, following the government guidance on social distancing, health and safety and PPE. Bringing those into stores is going to be costly and expensive. But what we can't forget is the backdrop of, at the moment, 8.4 million people have been furloughed. It's been a very, very difficult time for many, and a lot of our clients, particularly in the consumer sector, are worried about that consumer sentiment and that ability for their sales to ramp up gradually. We're certainly not going to see anything like sales in the way that we did pre-COVID, but with sales at current levels of something like 30% of what they were before, certainly the reopening of bricks and mortar stores should provide some acceleration, hopefully, for those sectors. For our clients, Kevin, what we've really been seeing are key priorities around cash preservation, and that's managing and reducing their fixed costs such as rents and salaries. So a lot of the negotiations around the March quarter day and concessions and granting either a monthly rents payment schedule or something to reduce those has been a key priority for our clients. That too, together with extended facilities, whether it be in relation to their existing loan facilities and share placements. We've seen recently the Northern-based leisure operator On the Beach PLC raising 65 million in a recent share placement and extending their RCF facilities. That's something we're seeing with our clients too. We are seeing our clients in the consumer sector with excess stock and lots of issues around that, together with supply chain issues and concerns in the hospitality and leisure sector. Our clients don't have a date to reopen. They need a lead-in time to do that. That's a great source of frustration for them when they're picking up again and looking at reopening their businesses, and they are looking at that across the board. They have to do that against a backdrop of they really don't know what occupancy rates will look like. We're seeing in Asia for reopening occupancy rates moving from 30% up to 50% in some mainland cities in China, for example. So whether we'll see that pattern returning in the UK, we're very hopeful that the UKation, which is holidaying in the UK, will really give some a boost to UK hospitality businesses, but whether that will happen in practice remains to be seen, because as we've set out at the outset, the uncertainty around timing and what's going to happen in our sectors for all of our clients is really, really unknown. And I guess when we talk about the real estate investment chain, we can't just talk about our clients who are occupiers. We talk about our clients who are investors and landlords, and what we've seen there too is something like two-thirds of rent payments not being made in the retail sector, for example. And other clients and other real estate asset classes, as Simon has just said, were less affected to a certain degree. But what we're seeing is that PropCo's large and smaller facing valuation reductions, as Simon said, and also loan to value ratio increases at the same time, which brings us on to real estate finance. Borrowers and lenders are facing LTV and debt service covenant breaches as a result of the crisis. This is something that our real estate finance teams are dealing with on a daily basis. The government has requested forbearance, and on the whole, the banks are doing whatever they can to support their customer base during this time. What we are seeing are increased inquiries around ways in which real estate occupational businesses are able to release equity through sale and leaseback structures, for example, which are good in the sense that they are effectively debt-free fundraising. But on the flip side of that, the clients who do move forward with those structures do find in due course that it does place them in almost a lock with that property. It's very difficult to make changes to it. They'll be limited by their ability to sublet or assign those leases, but also in terms of the use of those assets going forward. So they're all just considerations that need to be brought into sort of sharp focus. But the one thing I just would like to just finish on, and unfortunately it's not a positive note, and Simon, I wish I had a positive note like yours to end on, but just seeing just the news this morning around the hospitality and leisure and consumer sectors. TRG have announced this morning a CVA proposal and potentially closing 125 of their restaurants, and the fashion retailers Quiz and Monsoon Accessorize have gone into administration this morning as well. So we will see, unfortunately, for the pain to come, we'll see more restructuring in the sector. But what we are sensing is that this is, and Simon, I think that was a really good point that you made too, accelerating themes that were already underway, and that move to, selling across all, not just in bricks and mortar stores, but online, and trying to really reach out to customer bases in other ways, as we're seeing the likes of Prep doing with their home. You're able to take some of their products home and buy them online, coffee online. It's I think this is here to stay for some time.
Well, Susan, thank you very much. You told us a lot there, and your story covered a number of sectors and also a number of key points, particularly about release of equity and what are the best ways to do that. And I am sure we're going to come back to that storyline of sale and leaseback and the costs of the pound, as it were, in terms of what are the best options to think about, whether that's bank financing, debt financing, as you were touching on. And you talked to us also about where we are with some of your corporate clients and some of the considerations that they're having in the retail and leisure industry. So a fascinating overview, and I am sure we're going to get some further points coming in on that. So let's go to Marc. Marc, you've got some great experience working with Grant Thornton across many industries and across also many areas of the country. You're not just confined to one particular area, are you? You work nationally. And I guess in your thoughts, you must be looking at a number of different ways now of advising not just private sector about their options, but mostly on also the public sector too, who are also facing up to some enormous challenges and some stresses around their PFI deals and some of the negotiations that they've got with developers on their joint ventures. What can you tell us about options that are being thought about and considered?
Thanks, Kevin. I mean, very sobering. Everything we've just heard is very, very sobering. And I think there is a huge state of flux. What we're seeing is slightly more positive in terms of the trends that are coming through. And that's, we're working with corporate occupiers who are looking to rationalize their footprints and understand how to make a COVID-safe workplace, which everyone's putting safety first, which is absolutely right. And that will take 3 years to wash out in terms of those large corporates knowing what space they will release going forward, based upon what's the ratio of days that people work in the office as well. So that's one aspect. I think the more promising side is that we're seeing government and councils now being lent on to bring forward development projects that we've been watching for the last 2 to 3 years and have been slipping down the priority list as others overtake us. So regeneration projects particularly. But I think the most important part of all of this is, how does government raise money to develop these things? There is going to be a race for capital as we come out of this. We've already started to see it. We've seen Matt Hancock quite rightly say we've got to prioritise the rebuilding of hospitals. And we've been looking at 5 of those for the last 3 years, and nothing's gone forward on them. But I think there are other more important projects, such as prisons. Boris announced 6 months ago the need for 4 more new mega prisons. They're still on the drawing board, but why they're on the drawing board is, how do we fund them? And this is the biggest challenge. Regeneration projects where areas are deprived of industry. I think everyone's recognised building houses does not create jobs. All it does is create homes for people that can't work. So we've got to create areas that we can get employment into, and then housing has to follow very closely behind. So I think on the funding side, councils we're talking to, government we're talking to, are all saying, how do we go about it? Now, the interesting thing, obviously working with IPSX on a number of these cases, it's an interesting funding instrument, because I think it's a wonderful expression in March when the budget was announced that PFI had been retired, which was a very nice expression. There's many others that we could substitute that word for, but that's clearly off the table. So what other funding instruments are there? I think the most important one is joint venturing. I think most of these government bodies and councils are asset rich and cash poor, so they can't access debt very easily. They've got PWLB, but as we've seen in the last 3 weeks, there's a scrutiny now being placed and a bit of a microscope on how that's been spent outside of jurisdiction. A lot of it's been spent absolutely correctly, as you would expect. There's quite a degree that's been invested into commercial and unfortunately into retail. So it's had a double whammy. And some councils are on the brink of defaulting on their PWLB repayments. But I think the important thing here is IPSX does give us an opportunity of saying, well, how do we raise debt? How do we actually bring money into this? Mixing asset rich with cash poor clients, primarily government. And the interesting thing we've discovered, obviously, with IPSX is the fact that this looks at the future value of a development. So where we've been constrained by VFM, value for money, when we get into government speak, it's a very difficult thing to sign off when you're selling an asset in a depressed market. Are they getting maximum value? It's a very, very hard question to answer. Most of us say no, but you have to limit that degree. If we go into joint venture and we're able to put an asset into a joint venture, bringing the right expertise, developers, investors into that equation, and we can look at a different way of valuing the upside. And the upside is, what is the value of that development once completed? Now, as many developers on this call and as bankers on this call, I can see the carry cost is immense. So some of these regeneration projects take minimum of 5 to 10 years to see through to completion. And that's an awful lot of money to be carrying and a lot of risks to be carrying. But if we can borrow more money upfront and advance that construction faster, I think this has a huge leverage to be able to bring forward more projects more quickly, create more jobs, and get people back to work. So I think it's an interesting instrument, and I think we're now seeing the government rallying quickly to bring forward more significant regeneration and infrastructure projects, as long as we can find the capital to bring into this joint venture structure.
Okay, very good, Mark. Thank you very, very much. Some really interesting thoughts from you. So let's go back to Roger, who right at the beginning of the conversation was setting out for us the proposition of those 2 markets of prime and wholesale. Roger, listening to what Susan's been talking about with some of the constraints that her clients are under, listening to what Mark has just told us about where things are at from a public sector point of view, let's have a look at wholesale, if we may. How might wholesale begin to help ease some of those structural issues that we've just been hearing about?
Sure. So I'll answer in 2 parts. Firstly, I thought what Susan was saying about some of the limitations of sale and leaseback was very interesting. And of course, very briefly, there are elements that I think I referred to, of flexibility and optionality that partnering, raising finance from an exchange brings, compared to the traditional route of either a sale and leaseback or a JV sale and leaseback. I think in particular, this idea of future flexibility as an operator, as an occupier, is important, because of course people do a sale and lease back because they want to release capital from a building, but that building is still a very important tool to them that they run their business from. It's not an asset the way a real estate investor looks at it. But of course, if you retain some form of shareholding in the listed company, as I mentioned earlier on, it doesn't need to be as much as 75%, it could be as little as 20%. It makes you a very significant shareholder in that company going forwards. It also, you would have an ability to perhaps nominate a director to the board of that company. You might even want to continue to be the asset manager of that asset, and the company is likely to want to outsource that management rather than undertake it itself. All of which adds up to the fact that you don't lose control of the asset operationally or economically by doing a sale and lease back into a listed structure like we offer on IPSX. It's a completely new and important change. Also, it means as a listed company, as a partner going forwards, is slightly less intransigent than having some sort of big, ugly private equity partner who might want to push you around unreasonably. And lastly, the third and sort of critical change, one of the things we find when we talk to potential sale and leaseback corporate owners, is the fact that because this company is listed, and amongst other things, it means the takeover code applies to it, you could decide simply to buy back the company one day through a public offer. It would have to be at a fair price, it would have to be at the current price, and all that sort of good stuff. It wouldn't be abusive to other shareholders, but you could decide to do it. And I think these new elements of flexibility are game changers when it comes to corporates and owner-occupiers thinking about releasing capital. Secondly, as Mark was saying, yeah, I mean, we have had, for all the reasons Mark set out, we have found a lot of momentum and interest in the conversations we're having with public sector bodies, both central and local. And there's an additional element as well, which is really quite a cool thing that a stock exchange brings, which is the fact that some of that ownership can be either sold to or even granted to some of the key stakeholders. If I think, for example, of some of the housing regeneration projects where local tenants need to be brought along, and they need to agree to the changes that are going to happen to their community, and they need to approve them. One thing that could be quite nice for a local authority to do would be to actually grant some literal ownership in the community through the form of just a few shares to some of the tenants. We found that's really caught the imagination of some of the local authorities we've been speaking to. Again, what we're offering is something novel, something new, something that hasn't ever been available before. It's not necessarily a panacea, but it definitely should be in everyone's thinking as they go forward.
Okay, Roger, thanks for that. Let's get back to Simon and bring him in around this conversation of how a public market could start to help with this big challenge we've got around values and valuations. And indeed, we've already got a question that's come in from our audience around this. Simon, the question is, would evidence from a public market like IPSX provide and inform valuations in the context of the material uncertainty clause? So I think really where we're beginning to go with this is that if you have an open market where you've got price being provided every day that the market is open, that is giving you as an investor absolute transparency to the performance of how that asset is doing. How does that then help you with what you're trying to do with your valuation work? And take us through how you're beginning to see a shift perhaps between not just valuing the bricks and mortar, but also beginning to think about the value of the business that investors are really going to be interested in. How does that start to shift things around a bit?
Yeah, I mean, I think traditionally, we are obviously tied by the RICS Red Book in terms of property valuation, and a Red Book valuation values the bricks and mortar. It doesn't have regard to the owner or the structure or the ownership, just the method of ownership or the level of debt or anything like that. and therefore we are slightly tied by that. But certainly in the current market we're sitting in, we've got to have regard to the widest possible evidence and what is happening in the market, and we do, have regard to sentiment and what's going on. So if we see that there is very much a public market of shares being traded, and as we've seen from Roger, that's on a daily basis, then it has to be something which people will have regard to. It's if it is seen that assets on something like IPSX in, let's say, the regional office market are in high demand, then we cannot absolutely ignore that in doing valuations, just as we wouldn't ignore bond yields changing, or in theory the stock market changing. I think in terms of material uncertainty, it wouldn't mean that was removed, but it would be a factor to show that there was liquidity in a property-linked market. Things could move forwards.
Okay, so that's interesting. So let's just work with that thought a little bit more. Susan, I'm going to come back to you, if I may, and let's have a look at the context here of change. And you were telling us about how some of your clients are beginning to reflect on the use of their space and the way that they're thinking about operating around their space, which of course will have a big impact, won't it, on the kind of leases which they hold and the discussions that they're having with landlords and so on. And I'm interested in how things are beginning to move around in the Leeds market, and particularly where we're beginning to see demand for that space. And we've got a question from our audience here about, might we see the impact of COVID begin to have an impact on the regional office market, and not just Leeds, but outside of Leeds too, thinking about areas like York. Do you think we're going to see a fresh drive for more business flexible space in those kind of locations?
Kevin, I think it's a really good question. I think we will, and thank you to the audience member who's asked that question. I think we will see a great big drive into regional offices, and I think we will see a greater take up in particularly the Leeds market in terms of offices, where we have seen a huge take up in the last 24 months in particular. I know Simon and his team will be able to give the metrics around that, but certainly the taking up of the office space by Channel 4 and others coming into the Leeds city recently has given our market and our region such a boost. But just one thing I'd just like to quickly cover there, and that's just one of the changes that we're starting to see in terms of lease terms. They're shorter. We're seeing lots of, so the two instructions that I've had most recently in relation to lease renewals, and I think we'll see a lot of occupiers wanting to renew leases and re-gear them rather than moving space right now and incurring capital costs, because as I said, cash preservation is such an important issue for them at the moment. Yeah. And that is the shorter lease term together with some kind of rent-free or other inducement towards that to enable them to keep trading. But I think if Mark, you were discussing York as being potentially a market which there will be a lot of supply and demand outstripping supply in the future.
Thank you. Yes, let's hear from Mark in a moment. But before we did that, I want to just go back to Roger, if I may. There are a couple of points that I think I'd just like to clear up. First of all, Roger, could you just clarify, is wholesale only for private sector owners of real estate that are looking to raise finance, or might it also be available to public sector?
Yeah, absolutely. Public sector partnerships are very, as I was saying earlier on, very interested in what wholesale offers to them. Yeah.
Okay, and just thinking about the sectors, and we've seen quite a lot of activity in the markets over the last sort of few weeks in terms of capital raising. And I think it was Simon who was telling us a story about what was going on in the private medical sector. I mean, with your experience and knowledge of where investor appetite is at, what's your thinking about regional assets in terms of investor interest in those? And can you tell us a little bit at all about if there are any type of sectors that investors are showing a more curiosity and interest in?
Sorry, Kim, that's me.
Sorry, Roger. Yes, to you.
Yeah, no, I think, and just picking up on what Susan was saying, definitely I see this. It'd be interesting to hear from Simon in a moment about what he sees in terms of valuation. But when I talk to investors, that story, that idea that people are not going to, in future, want to sit on or stand rather on a packed train for an hour and a half to come into London, to get on a tube, to go to an office. That now I heard someone saying to me they'd been into, I think actually it was Mark, saying they'd been into one of the investment bank offices down in Canary Wharf. You know, Barclays are saying it would take them 2 days to get all of their staff in and out of their office at the moment. Clearly, the new normal won't be able to work the way it did. And I think one of the obvious beneficiaries will be moving to a more regional hub kind of office network system. That will definitely happen. I also think that the BTR, it follows that the BTR sector outside London in some of the more regional cities will attract much more interest and much more strength. So, you know, Manchester, Liverpool, Glasgow sort of markets. And of course, it will continue to be the case that logistics will get strong investor demand. I saw SEGRO announced a very large placing yesterday, which they upsized, just like London Metric did a couple of weeks ago, close to the prevailing premium pricing. So the new normal is attracting a lot of investor demand already.
Okay, so we've got some trends emerging here that we can definitely begin to see. And Susan was very eloquent in the way that she was explaining that. Let's bring Mark back in, if I may. So Mark, you were talking about the need not just to think about financing for housing, but also the need to create jobs. And I can well imagine that there must be a number of discussions here about prioritization and priorities. So might there be here a ripple effect as a result of COVID, where we begin to see not just the creation of new houses and new areas of conurbation beginning to grow, but also new local jobs beginning to be growing as a result of this sort of displacement conversation that we're beginning to have? What's your thoughts on that? And second question for you, whilst I've got you, can you just tell us a little bit more about where you are seeing public sector finance? And you were beginning to hint here at what was been going on with Public Works Loan Board. What's your view? What's next? If PFI is out the door and you were saying it's been retired, a graceful way of putting it, where do we go next? So two questions for you, if I may.
Yep, no, thanks, Kevin. I mean, the first and foremost, we've done a lot of surveys over the last 9 weeks on behalf of clients of their employees. I think large corporates, and I'm talking about the large office occupiers here more than the manufacturing side, have had to rediscover who they employ, which sounds very strange, but I think it's understanding just how far people commute to work. I think we've lost sight. I mean, there used to be a statistic, it was 45 minutes the average journey. Reality is it's 2 hours each way for those working in London, for instance. So I think there's an understanding of people's appetite. The poll clearly states that they don't want to come back to the office 5 days a week. This isn't a risk or concern over catching COVID. It's a lifestyle choice. They've taken this moment in time to say, actually, there's more to this. Paying a lot of money to stand in a sardine can on a train that doesn't always arrive is no pleasure. And when they get to the office, they're slightly stressed and not best focused. So I think what we've written and published more recently is that we're not going back to the office we left. I think the office we're going back to, and this isn't going to be overnight, it's going to take at least 2 to 3 years to play through, won't be rows and rows of desks. It won't be densely packed. It'll be collaborative space. It'll be space where people go to meet comrades. It will go to create and share ideas, and they'll return to their desk at home to do the work. And that will start to play out in releasing space longer term. The push and the pull here, the first phase of building that confidence we're seeing is being led by HR, and the second phase is very much being led by the CFO. And there's a push and pull to say how quick can we make those savings. And that is then starting to say that if people don't want to travel into the cities because the infrastructure is not getting any better, will we see the uptick in regional offices? It's absolutely clear. We're working with 4 global organizations at the present second, and all of their interest has been spiked to increase their footprints in their regional offices, because in the short term, people can drive to them. They're easy to access because they're probably lower story. They're probably 3 or 4 stories rather than 30 or 40 stories. They're probably closer to people's homes, so it gives them flexibility. And most importantly, it's keeping their staff safe, which is number 1 priority. I think in terms of funding, Yeah, it's an interesting challenge. I don't think we've got a solution yet. I think the interesting thing is there are 4 or 5 significant projects, and one literally started or popped out of the machine just yesterday to write the business case for the government on. And it is a significant 10-year project made up of 7 different sites. And the number one question that we need to answer is, are there enough investors and developers in the marketplace today that would be interested in participating? So not one, how many are there, and are there enough? And I think part of that is their ability to raise debt. The investment is sound. It's a fantastic location. It's constituent of offices. It's all the ingredients. But unless we bring the right skill sets, the developers in with the right financiers, these projects won't go forward. So government are absolutely hell-bent to make sure they do go forward, to create those jobs, get people back into work, and get the economy back on track.
Fantastic words there, Mark. Thank you very much. Let's go to Simon and get some reflections from him and what you've been hearing, particularly from Roger, talking about investor appetite from this new public market that gives the ability to raise finance. How do you see that beginning to play out? And also from a Leeds perspective, how do you begin to see values beginning to move and change? Thinking about what Simon and what Susan have been saying about how we might begin to see occupational shift.
Yeah, I mean, I think, you know, it's stating the obvious that the more participants we have in the market and the more ways that we can see deals funded and structured, then it has to be to the good. You know, we are going through a period of immense change in so many different ways. And I think people are looking at new ways of funding things, and, you know, be it IPSX or something else, then it has to be a positive thing to get a new option. I think, you know, everyone's been talking about the future of the office, you know, is the big talking point in many places. And as everybody's been saying, it's going to change. I think Leeds doesn't have an oversupply of space, and I think he's pretty well placed to capitalise on that. We aren't forecasting as a house that rents are going to fall, and we do see that investors are attracted to the region, so there's some stability there. And I think you can almost apply an identical argument with logistics and industrial, that people are going to want more logistics space. They're going to want to spread their logistics space a lot wider. And again, I think as a region, we can capitalise on that going forwards.
Okay, thank you very much. Right, well, we're drawing to a close here. So we're going to finish the session as we started. I'm going to give 2 questions to our audience. And then once we've posted those questions, I'm going to come back to the panel for their final remarks. And panel, you might like to think about some of the comments that have come out of our last sort of 60 minutes conversation, or you might like to reflect on what we're going to get back from these polls over the next a minute or 2. In terms of order, I'm going to go with Simon first, followed by Susan, Mark, and then Roger. I'm going to finish with you for the closing words, if I may. So let's get our questions up for our attendees if we can. First question, please. So, question for our audience: do you think we will see businesses moving away from the more traditional approaches of debt finance, considering new options for using their real estate assets? If you do think that's going to start to happen, please say yes. If you don't, you think we're going to continue with the more traditional approaches, vote no. So if you would like to just vote away, please. We'll get your responses to that in a moment. Great. Okay, let's get the results to that poll. Well, hey, look at that, 90% shift. Fantastic. Thank you very much. Okay, let's get our second question up, if I may. All right. Regional question here. Do you think that the Yorkshire and the North is in a good place to recover more quickly than other parts of the UK as we emerge from COVID-19? Okay, audience, please vote away. We're asking you about your views of the robustness of the Yorkshire and the North market. So vote away, please, and we'll get your thoughts on that in a minute. Okay, let's get the poll results to that. Hey, look at that, 90%, wow. And I have to say, out of all the regional webinars that we've been doing around the country, we've been asking this question, and I have to tell you, well done. You have proved beyond any doubt that you are the most optimistic and bullish out of all of the regional markets that we've been in so far. So well done, audience. Fantastic. Thanks. Great. Let's take that poll result round. Now, panel, it's closing thoughts time as we come to the end of our webinar today. Thank you all very much indeed for your contributions. But let's go for our closing thoughts, please, if we can. Simon, we're going to start with you first.
Yeah, I don't think it's Yorkshire optimism and being bullish. I think it's absolute realism that we know we can do it and that we are the best. Just very quickly, just on almost a different tack to what we've been talking about, I think the other big change which is going to come forward is that the increased focus on corporate social responsibility. I think there is a massive focus on well-being with certainly our employees, and I think that's going to come through to sustainability. JLL announced that we were going to become net zero carbon by, I can't remember when, 2025, 2030. I think this will only accelerate that for us, and I think for a lot of businesses that's going to happen, and therefore investors, developers, for local authorities, they are going to have to put that higher on the agenda than it even was before.
Great point, Simon, and I only wish we had more time to explore that, because that takes us off into a completely different direction, but I love it. That is fantastic words. Thank you so much. Susan, brilliant. Thank you so much for your support today and for being our virtual host.
Very welcome. You're very welcome. Yes, sustainability and ESG, we are also looking at as being one of the key considerations for all of our clients, real estate sector and across the board. It is a very, very important consideration in relation to the real estate requirements, and what we're seeing too in our clients when they're looking to reopen is to look at more sustainable options in terms of their sourcing, in terms of supply chain, but also in terms of the facilities that they're operating. So yeah, I think that's a really good shout out, Simon. Thank you.
Thank you, Susan. And we'll go now to penultimately to Marc.
Yeah, I think I'd just encourage everybody with these large projects, don't be put off by the procurement process. I think there's an active program going underway to reduce the costs and time involved with competing for some of this work. I think if there's an ambition to get involved, then get involved, because it's not going to be dominated by 2 or 3 large developers. I think there's going to be a syndication of developers, and there's going to be a syndication of financiers. I think that's why it is an extremely troubling chapter. There's an opening door, and I think we've got to focus on that and row through it. I'm a Yorkshireman. I live in Yorkshire. Yes, I work in the city, but yeah, I'm very proud of the northern region. I think we're in a good position. You mentioned York. York has an undersupply of offices. It's a great place for people to go and work and live. It's well connected with the train. It just doesn't have the same office supply as Leeds. If we invest in cities like that, the north will only go from strength to strength.
Fantastic. Thank you very much indeed, Marc. So, Roger, the floor is yours to close our webinar today.
Well, yeah, and Kevin, I'll join you in thanking everyone, all of our panelists and all of our viewers. So look, I think we've all talked in different ways at different times in the last hour about how things have changed for forever. I think the amount of government involvement in our lives, government financing in our lives, is something that we just couldn't have imagined from any government, let alone a Tory government 6 months ago. And the way we behave is going to change more than any time in our lifetimes. People are open to that. And what does that mean? It means we've all had support from the government, whether it's through furloughs, through rates changes, etc. More than ever now, people who own real estate, they need to be on shore, they need to pay their taxes, they need to be transparent and make disclosures. We need to open up the asset class to as many investors as possible. And we're all absolutely on board with that at IPSX, because we're here to help make that happen.
Thank you, Roger, for great closing thoughts. And once again, thank you to our audience today for joining us. It's been our pleasure to host this. Thank you once again to the panel for taking part. Please do jump onto the IPSX website if you'd like to learn more about that, where you can also download our other podcasts and webinars. I am sure that DLA, our friends at Grant Thornton and indeed JLL would be delighted to hear from you, as indeed we would, if you'd like to pick up on any of the points of the conversation today. So it only just falls to me now to say thank you very much and to wish you all a very good day and goodbye.
Thank you.
Thank you.
Goodbye,
Thank you, Kevin and I.